Welcome back to the Retirement Fiduciary Podcast, your classroom for no BS financial education. A place where we have authentic discussions about retirement planning, investment management, tax reduction strategies, insurance estate planning, and more. Here's your host, Adam Koch, President, Portfolio Manager, and Senior Financial Advisor at Libertas Wealth Management Group.
Hey, what's going on, everybody? Welcome to this week's podcast. Today, we're going to be talking about something that happens to the markets all the time. In fact, I titled the podcast Up the Escalator to Down the Elevator because that's kind of how the markets work. You tend to see kind of a slow and steady uptrend when the market's going up, and then all of a sudden there's a pullback or a correction or a severe correction, and you see this big, huge drop that kind of tends to surprise everybody and frankly kind of freaks some people out. So today we're going to be talking a little bit about that, but first of all, if you have not watched one of our podcasts before or listened to one of our podcasts, thank you so much for joining us. The Retirement Fiduciary Podcast is produced bi-weekly, and you can feel free to check us out online at libertaswealth.com. You can find me, Adam Koch, online at not only at libertaswealth.com, you can also find me on LinkedIn if you want to connect with me there. And then if you'd like to get a second opinion on your financial plan or your portfolio, feel free, of course, to head over to libertaswealth.com, click on the button that says see if we're a good fit, and then just kind of go from there. All right, let's get down to business here. Let's start with the quote of the day, as always. And today I took some time to look this one up because I wanted to make sure it made sense. And Linda Raschke said, there is no single right way to trade, meaning invest your money, trade the markets. So there's no single right way to trade, but the wrong way is to pick tops and bottoms. And we're not just talking about market timing or trying to pick market tops or market bottoms. We're not just going to talk about market prediction or trend following today even, which we do talk about a lot of those types of things. In fact, it is September 19th when this is being published, and normally I wait until November, or as I call it, Nerdvember, to do some of these more technical podcasts. But again, we had a pretty swift market correction earlier this year in spring. We had another one in mid-July through early August, and I thought that it made sense to kind of put some things into perspective and look at some things that might help you, identify what the market's doing at any given time. And again, just kind of put things into perspective instead of knee-jerk reaction freaking out. Whenever you see a correction take place, to pull up a chart, look at this particular tool I'm going to teach you about today, and then maybe not worry so much. So first of all, just a couple definitions. What we're going to be talking about today is something called daylight, originally a term coined by Dave Landry. In fact, he called it Dave-light, which I think is pretty cool. But anyway, so daylight is what we're going to be talking about, and it has everything to do with something called a moving average. Now, it sounds way nerdier than it really is. A moving average is basically a trend line. Well, what's a trend line? Well, a moving average is basically the average price of any investment or index, for instance, like the S&P 500 index, the NASDAQ index, the Dow index. So it's the average price of any investment over a specified period of time. And you get to choose that time. So it doesn't really matter what period of time it's over. It's just you can look at a price chart of the S&P 500 and look at the daily movement, which is obviously the movement of that chart on a daily basis. You can look at the last 5 days. You can look at the last month. You can look at the last, the last year, and you can look at daily price movement of that index. And you're going to see kind of some jagged, volatile movements, basically, or at least typically that's what you would see. Whereas when you look at a moving average, what it's doing is it's taking the average movement of the price of that investment or index, and it's smoothing it out over a period of time that you choose. Obviously, the shorter the period of time, the more ups and downs you're going to see in the moving average, and the longer the period of time that you choose, then you're going to see kind of an even smoother ride, if you will. So let's talk a little bit about the different types and popular periods that are used. So first and foremost, I kind of gave it away earlier, but you've got daily moving averages. So we can look at a daily chart and pull up a daily moving average. If we have a weekly chart up, we would look at a weekly moving average. And then, of course, you're getting the drift at this point. If we have a monthly chart, then we might look at a monthly moving average. So a popular one that I like to use for long-term investing would be, a monthly moving average using the 10 period. So 10-month moving average. So we might look at the stock market over the last 2 years or even the last 12 months even, and we would look at what's the 10-month moving average over the past, so the average movement of the S&P 500, let's just say, over the last 10 months, and then how the market, or in other words, the index, is trading versus that moving average. Now, another way we can look at this is the popular periods to use. So 21 days is a month. Trading days are obviously market only trades 5 days a week. Unless there's a holiday, then it would be shorter. But there's 21 days is essentially what is commonly referred to as 1 month. 50 days, a 50-day moving average is just a commonly used moving average. It's not quite 3 months. It's 63 days would be 3 months. So a 50-day moving average, but it's pretty commonly used. 150-day moving average, the reason I brought that one up is because I personally like to use 150-day moving averages on relative strength charts. Now, we're not going to talk about that today, and I worry that I already just made it too confusing, so let's just stop there. But 150 is one that it can be popular, and then kind of like the 50-day moving average is really popular. The 200-day moving average is extremely popular. In fact, if you've ever heard of the phrase death cross or golden cross, what those crosses are is when the 50-day moving average crosses below the 200-day moving average, that's called a death cross. And when the 50-day moving averages cross it back above the 200-day moving average from below, then that's called a golden cross, which is a good thing, obviously. And it essentially means that the market is trending up. So those are the daily charts. Now, you can also look at weekly charts. I already mentioned that from a monthly standpoint, a 10-month moving average would be my favorite. But weekly, 10 weeks is a very popular moving average. So a 10-week moving average. So the average movement of the price of an investment or an index over 10 weeks. 13 weeks would be 1 quarter. So 3 months. And then 40 weeks is the same, is also pretty popular. And there's reasons why the 10 and the 40 are popular. And that is because 10 weeks is the same as 50 days. And 40 weeks is the same as 200 days. So when you look at the math, essentially you're looking at the same thing. The only difference is by looking at a weekly chart, it slows things down a little bit. It means you're making less decisions, or at least fewer decisions, which is oftentimes a good thing. When you make lots of decisions, or you make decisions more frequently, you have a tendency to get what's called whipsaws. Or in other words, you might have, you might sell something that a few days later you wish you wouldn't have sold, and now you feel like you need to get back in, or you worry if you get back in, it might go back down again. So it kind of, creates these short-term whipsaws, like whippiness. Whereas with a weekly chart, you might wait until Friday, to make a decision and say, okay, at the close Friday, here's what the market's doing, or here's what this stock's doing, or this ETF is doing. And then at the close of the week, you can do your analysis. And then on Monday morning, you can look at it and go, okay, has anything changed on Monday? If not, then I'm going to sell it. Or, maybe I don't do anything and you just hold on to it. So those are kind of the popular moving averages. Now, what is daylight? Daylight is the space between the investment or index in question and its moving average. So you can almost say that backwards right now, because the moving average would be below the price of the investment, or the S&P 500 as we're going to look at today. So the space between it is what we call daylight. Now, let's make this visual and maybe a little bit more obvious. So this is a candlestick chart of the S&P 500 going back to October of 2022. Candlestick chart, you can see it's got either a hollow body or a filled body. Then it has wicks on either side, and we're not going to talk about that today, but basically it's kind of a messy chart, and most people look at this and they think, oh my God, leave me alone. I don't want to talk about this. This is confusing. It's messy. I have no interest. Just shut up. I don't want to hear anything about this. It's too messy for me. It's too nerdy. Well, what we can do, instead of looking at the daily, because every one of these candles is 1 day's movement, and then you can look over time and kind of see what it did over the period of time. But what we can do is go straight to a long-term moving average. And what I'm going to put on the chart here is a 200-day moving average. And this is what it would look like. So this shaded area is the average movement of the S&P 500 in this case over the last 200 days. So if we look at this chart and we look at this moving average today, what it's doing on this day is basically the average price over the last 200 days. The day before is the average price of the prior 200 days, and so on and so forth. And as you keep doing that calculation over and over again for 200 days, what you end up with is basically a smoothed out version of what the investment, or in this case, the S&P 500 is doing. And so as you can see here, we have a moving average that is trending up. Now you can see back here, it was trending down, and then because that's in 2022, 2021, 22, the market was going down, and so the moving average was sloping down, which is not good for the market. Obviously, we want to see either a flat or rising moving average. And then in a perfect world, we want to see the investment or index in this case trading above the moving average when it's rising. That's in a perfect world. Now, what we don't want to see is times when the market, or in this case, the S&P 500, goes below that moving average. I call that going underwater. And I always say that, we can spend a few days or even a couple weeks below water, but the more time spent below water, the less oxygen our portfolio is getting, and therefore the higher the probability that the trend is changing. So if it goes below water, we want it to go below water a few days, a few weeks, whatever, come right back up. And that's what happened here in October and November of 2023, after a pretty nasty correction going back from pretty much August through Halloween. But anyway, so what we're looking at here now, again, S&P 500, and then the S&P 500's 200-day moving average, or 200-day trend line, if you want to call it that. Now, what is daylight? We already talked about getting below water and how that's not a good thing. Daylight is the space between the moving average and the price of whatever the investment is. In this case, the S&P 500. So here you can see there's a lot of daylight. Here we can see after a market correction took place this spring, we see much less daylight. Then the market starts going up again, and it starts rising faster than the moving average is. So what you end up with is a lot more daylight again. And the point I want to make today, and this is huge, this is the lesson I'm trying to teach today on this very short podcast, is that the more daylight we have at any given time in any investment or in any market index, the more daylight we have, the higher the probability of a market pullback or market correction. Let me say that one more time. The higher the market goes relative to its moving average, the more daylight we have, and the higher the probability of a market pullback or market correction. If I translate that or elaborate a little bit more, what that essentially means is the more the market goes up and the faster it goes up, the more daylight we see, the more we should expect the market to come back, and the more we should expect it to roll over, to pull back, to correct in some way, shape, or form, whether that be over price, meaning correcting downward in price, or correct over time, chopping sideways and letting that moving average catch up, so to speak. So what we saw this past summer in July, so between July 15th and the beginning of August, was we saw a really, really swift downward move of almost 10% on the S&P, and then I believe about 16% on the NASDAQ, which is not shown here. So tech stocks obviously got hit a little bit harder, but we were at a point where there was so much daylight in this chart that it shouldn't be a surprise to anybody. But think about what you were hearing back then, if you can remember. Think about what you were watching on TV. Think about what you were seeing on your phone, on apps and news apps. If you pay any attention to the market at all, what were they saying? On CNBC and things like that. They were talking about the markets in turmoil. They were talking about emergency Fed cuts, things like that. So when we're living through something like this, which, by the way, the market correction that took place between July 15th and the beginning of August this year, and when you compare that to the market correction that took place between August and beginning of August and the end of October in 2023, it was short and nasty this time, but it was longer when we look back at last year. It was this period of time where not only from August until Halloween, were we looking at a really, really long grinding, I say long, it was 3 months, but a grinding decline. But you've got these little head fakes in here where the market goes up and makes you think it's going to come back, and then it doesn't. And you get this lower high, and then a low, and think, oh, maybe it's going to start going up again. Then you get a lower high. Then it cracks below that prior low. Then we have a new low, then another lower high, and then another lower low. But worse yet, now we're below water. We're below the 200-day moving average, which, as the saying goes, nothing good happens below the 200-day moving average. And you can also say, mathematically, nothing good happens below the 40-week moving average. So that was a little bit nerve-wracking. But of course, we forget. None of us, except those of us in this business and in the profession of dealing with the markets, none of us remember this happening last year, because it feels terrible in real time. But once this is passed, just like this one here that we're dealing with right now, we're not going to remember this one next year. Come next spring, we won't remember anything about this most recent market correction that we saw this midsummer. And I guess that's the lesson I want to teach. Two lessons. First, the higher the market goes, the faster it goes, the more daylight, the higher the probability of a decline. And we should not be surprised by that decline. We should not be worried. We should not freak out. But when these declines happen, we forget about them. We don't remember them happening anyhow. So I think it's important to keep things in perspective and understand that things aren't always as they seem or as the financial media makes you think maybe. Now, just for fun, I went back in time here to 2020, just after COVID, 2021, and I wanted to look at some other recent times that we see this daylight happening. And I think it's funny here because in September of early September, end of August of 2020, we saw quite a bit of daylight here, then a big pullback, and then we saw some more daylight and another pullback, and then there's this period that I'm calling summer in Alaska, because there's this period of time between, we'll call it late 2020 and I don't know, it looks like about end of the third quarter of 2021, where we get daylight almost the entire time with very, 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 very mild pullbacks. I mean, you can barely call them pullbacks. This is one right here between September and October that lasts 4 weeks is all. I'm not going to do the math and try to figure out what percentage decline that is, but it wasn't bad. And then we get some more daylight here. You can see again, let's see here, early November, again in late December, and then the market pulls back, goes below water, pops back above water, back below water again, but for several days, several weeks, back above water for just a few weeks, then back below it again. And now we have a problem on our hands. We're seeing lower lows below water. So in other words, we're seeing lower lows and lower highs below the 200-day moving average, even though the 200-day moving average is rising. That's still a good feather in the cap for the bulls. But when it starts to roll over here in mid-late April, when we start to see a declining 200-day moving average with further lower lows going below the 200-day moving average, and then when it tries to rally, and all it does is tap the top of the C here, if you will, and continue heading lower, that's not a good thing for the market. All this is bad. So anyway, I digress. I didn't want to spend much more time on this, but I purposely used stockcharts.com today because it's free. Anybody can go on stockcharts.com, pull up some of these charts that look very similar to what I'm using. I'm using colorblind charts because I'm colorblind. So I customize all my charting so that I can distinguish colors from one another. But when you pull up a chart, I pulled up a candlestick, daily candlestick chart. This one you just looked at was a time period between, like I said, post-COVID and late 2022. You can change that to the last 1 year, last 2 years, like my other charts were. This extra bars just leaves some space on the right for you, just to give you a little bit of room. Chart size, if you have the free version, you won't be able to go this big, but you'll get, just make it as big as you can. And then from there, just go down to overlays, click on the drop-down menu, click on simple moving average or exponential if you want to get nerdy, but exponential moving averages just basically weight the most recent data heavier than the old data. So it moves a little bit faster, but a simple moving average equally weights every day equally. And then 200, so a simple moving average here, 200 days, because we're looking at a daily chart. If this is 200 and it was weekly, then it'd be 200 weeks. That would be way too long. So you'd want to look at something like a 40-week moving average or a 10-week moving average if you wanted to be really fast. And then on the right here, this is going way overboard, but I just wanted to share it with you because this is what I did. I like using the whole concept or the analogy of above and below water because it makes a lot of sense to people. So when you choose area, that ends up being like a filled in area. I use blue, and then I make the opacity 0.4, which makes it so that you can still see the candlesticks or the line. If you want to change this candlestick to line chart, you can do that too. And you'll still be able to see it below water, or in other words, when it's below the moving average. So hopefully that was interesting, and I hope that you learned something today. If you, again, have any questions, if you'd like to get a second opinion on your portfolio, your retirement plan, financial plan, please reach out to us at libertaswealth.com. You can also find us on all the socials at Instagram, Facebook, TikTok, Twitter. LinkedIn, I mentioned earlier, is a great place to get a hold of me personally. And then we also have a sister company called Elevate and Exit. The website is elevateandexit.com. It's exclusively for business owners, and it's all about business transition planning, essentially helping you transition your business from wherever it is today to wherever it is you want to be. In most cases, people want to be more efficient, more profitable. They want to have less risk, and they want to put themselves in a position where if anybody wanted to buy them, they'd be ready to buy or ready to sell yesterday. So I'll end with that. Thank you so much for joining us. As I always say, there's thousands of podcasts out there. You chose to give ours a listen today. So thank you so much for joining us, and we'll see you next time.
Thank you for joining us on the Retirement Fiduciary Podcast. To see any charts or images that were mentioned on this show, to check out additional articles, videos, and other educational resources, or to set up an intro call with your host, Adam Koch, just head over to libertaswealth.com. This podcast is for informational and entertainment purposes only and should not be relied upon as a basis for investment decisions. None of our shows engage in rendering legal, financial, tax, or other professional services. Always talk to a certified financial planner or fee-only fiduciary financial advisor before implementing any of the ideas shared in this episode.